What exact measurable organizational value is generated when a supply chain is managed correctly? Historically, corporate leadership associated supply chain management with the physical movement of cargo and the reduction of freight costs. The Oliver White framework defines the supply chain as a conversion engine, translating business strategy into results across service, cost, cash, and resilience. Physical flow determines service levels and costs, while inventory speed and network structure dictate cash and resilience. To evaluate how localized actions produce these results, we can map supply chain outcomes across a six-dimensional model. Mapping these dimensions allows an organization to trace how a single operational change cascades through the entire enterprise. The first dimension of the framework focuses on market-facing outcomes. Precision in the supply chain manifests as shorter lead times and consistent product availability for the end consumer. This diagram shows demand-side performance. The primary metric is OTIF, on time in full, measuring the ability to meet requirements exactly as promised. Consistent OTIF acts as an order winner, differentiating a company, securing satisfaction, and supporting market share growth. This reliability creates a feedback loop. When customers trust delivery timelines, they reduce safety stock and stop submitting erratic, panicked orders. This stabilized demand makes the supply chain easier to manage. Supply chain initiatives that ignore these market dynamics in favor of internal efficiency often create unintended friction for the customer. An organization prioritizing cheap warehousing over delivery speed will struggle with customer retention, even if internal costs appear lower. On the demand side, supply chain reliability is the primary driver of a company's reputation for performance. The second dimension examines outcomes from the perspective of the Chief Financial Officer. The CFO evaluates the supply chain based on its impact on the company's total pool of working capital and long-term asset productivity. This loop visualizes the cash-to-cash cycle. By increasing inventory turns and reducing the cost to serve, a company accelerates the speed at which working capital returns to the business as free cash flow. This reduction in stagnant inventory directly increases the company's return on assets. The Oliver White methodology identifies a specific danger in prioritizing cost minimization above all other metrics. When a company focuses solely on lowering immediate costs, it often strips away the buffers necessary to manage variability, which increases long-term operational risk. The objective is to optimize profit and cash flow simultaneously, balancing the cost of operations against the revenue generated by reliable service. For example, pay in the premium for expedited shipping can result in higher total profit if speed converts inventory into cash weeks earlier than standard freight. Effective financial supply chain management optimizes the velocity of capital, deploying funds to maximize enterprise profit rather than simply minimizing a single budget line. The third and fourth dimensions focus on execution excellence and the alignment of internal departments. Without active management, departments often work at cross purposes. Sales chases revenue, operations chases factory efficiency, and finance protects cash, creating systemic conflict. This funnel represents S&OP. It takes inputs from sales, operations, and finance, forcing them into a unified plan and establishing clear decision rights to make explicit trade-offs. This results in high plan adherence, reduced expediting, and lower daily variability. McKinsey describes this outcome as decision coherence. It ensures that every part of the organization is operating with the same logic and priorities. To reach this state, an organization must replace siloed, department-specific targets with shared performance metrics. A reliance on daily firefighting to meet customer needs is a primary indicator of systemic failure. When planners must act as heroes to fulfill basic orders, it confirms that the underlying supply chain structure is not functioning. Operational alignment shifts a company from a reactive state to a proactive, predictable model. The final two dimensions address long-term survival and the ability to execute high-level business strategy. This scale defines resilience as the ratio between efficiency and flexibility. Here, extreme cost-cutting pushes buffer capacity dangerously low. When disruption occurs, this overly lean network collapses. A balanced network, however, uses flexibility to absorb the shock and maintain service. This is measured by time to recover, or TTR, the exact duration required for operations to return to normal after a shock. Finally, we view the supply chain through the lens of the CEO and the board of directors. A mastered supply chain provides the capacity and speed necessary to scale into new markets without structural delays. This enables the CEO to execute complex strategies, whether that involves cost leadership, product differentiation, or rapid responsiveness to market shifts. Structural resilience and strategic alignment within the supply chain are the foundations of sustainable competitive advantage. We can synthesize these 6 dimensions by looking at the mechanical chain of causality that drives them. The process begins with specific supply chain actions, forcing coordinated decisions across the enterprise. These decisions remove friction, leading to a consistent flow of goods and information. This flow generates the 4 pillars of systemic value: superior service, lower cost, faster cash, and higher resilience. This framework provides a tool for evaluating your own operational reality. Consider these 3 questions. Which outcomes is your organization sacrificing? Are you designing for efficiency or resilience? Finally, what do your KPIs actually reward? Auditing your internal metrics will reveal whether they support this multidimensional value or if they encourage siloed, cost-focused behaviors. Managing the trade-offs between service, cost, cash, and resilience is the defining task of modern supply chain leadership.